Hi, I'm Jared Ripplinger. I'm a tax manager with Cook Martin Poulsen, and I'm going to talk to you today about choice of entity. We get a lot of questions about what type of business is best as someone's looking to set up a new type of business. We'll be going over the four major types of business entities and some of the advantages and disadvantages, and a couple of situations where they may be one type of entity may be more beneficial than another type. The first type is a sole proprietorship. This is the most simple, the most basic type of business entity. There's nothing formal that needs to be filed with the state. You just simply open a business and start operating the business. This can work for service industries, or if you're selling a product or reselling product. Even some simple manufacturing may benefit by having this type of a business entity. Because it doesn't have any formal setup process, there's also no legal protection for a sole proprietorship. So as the owner of a proprietorship, you're fully exposed legally if something goes wrong in the business. So that's definitely a disadvantage, whereas the setup and the ease of operating this type of business is a big advantage of this type of business. A sole proprietorship does have some tax disadvantages also, in that all of the net income after your tax deductions is subject to self-employment tax. Self-employment tax is simply an employer and employee portion of Social Security and Medicare tax that is assessed to businesses. Sole proprietorships are very simple to file a tax return for. You simply include a Schedule C with your individual tax return. Report the revenue and the expenses for the business and calculate the tax based on that. So very simple. An example of a business that may benefit by operating as a sole proprietorship would be a business that doesn't have much revenue. So if you have a small business and you sell a few crafts at a farmer's market or at the fair or something like that, where your business activity isn't substantial, it might be sporadic, that could be, a sole proprietorship could be a good choice of entity for you because of its simplicity. Also, there's no cost to renew the business each year. You just simply file and report the business activity as part of your personal tax return. The next type of business that we're going to talk about is an LLC or a partnership. The reason why generally LLCs and partnerships get grouped together is if an LLC has more than one owner, then it is automatically classified as a partnership for income tax purposes, unless it makes an election to file as another type of business. So a single member LLC is going to be a disregarded entity, whereas a multi-member LLC is going to be a partnership or could potentially elect to be taxed as a corporation. We'll talk about corporations a little bit later on, but for purposes of this discussion, we'll just treat LLCs and partnerships as the same for tax purposes. An LLC does need to be formally organized with the state. There are articles of organization that are filed with the state, and that license or that business entity is then granted from the state. This is a very common type of business, and in fact most small businesses are formed, at least initially, as an LLC or a partnership. LLCs offer a lot of advantages over sole proprietorships in that there's now legal protection by the state because there is liability that's generally limited to your investment in the business, whereas your individual or your personally owned assets are typically safe from creditors. If you have other partners in your LLC, you'll definitely want to make sure that you have an operating agreement, especially if the other owners are, it's not just an LLC owned by two spouses. As soon as you get other ownership in there, it's important to spell out the terms of ownership and under what conditions ownership can change, or you can bring in new owners or transfer ownership of existing owners. And that's part of what an operating agreement does. It spells out all of those situations, and that way everyone's on the same page, and if one of those instances happens, then you just have to refer to the operating agreement, and it spells out exactly what you need to do, what the steps are in transferring ownership. An advantage of an LLC is that it's not double taxed. So the income that's generated by the LLC is then reported to each of the owners of the LLC based on their portion of their ownership of the entity. So you would get a K-1 from the LLC, and you simply report the information from that K-1 on your personal tax return. And then the tax, if any, is paid by you as part of your personal tax return. So fairly simple, but it has an extra step that a sole proprietorship does not have. An LLC is also very flexible as far as what type of ownership structure you can have. An LLC can be owned by other entities, including corporations or individuals. It can be owned by other partnerships or LLCs even. So a lot of flexibility there. You can have an LLC with different layers of ownership, where some of the class of ownership has certain rights and certain preferential distribution treatment, whereas another class might have other rights or other restrictions. So not all of the ownership has to be the same with an LLC. You have a lot of flexibility. An LLC is the preferred type of entity to hold real estate because of the flexibility of transferring real estate in and out of the entity without generally triggering a tax. So anytime there's an entity that you want to form and you want to have assets transferring in and out, an LLC is definitely the type of entity to go with. So very popular for rental property. It's a very good type of entity to give you that legal protection, to form a barrier or a firewall between different properties that you hold if they're each held in a different LLC. Also, another common structure is to operate a business in a corporation or as a sole proprietorship and rent the building or the real estate from the LLC. So there's a lot of different ways that you can combine different types of business entities to best meet your situation. For ordinary business income generated by an LLC, generally, if you're active in the business, your portion of the income is going to be subject to self-employment tax, just like a sole proprietorship would be. And so that can be an advantage or a disadvantage depending on your perspective and what you need for your business. So you have to decide that. Again, with real estate, there's not a self-employment tax issue, so it's a great way to hold real estate. If you're an operating business, sometimes it's more preferred to operate the business as an S corporation. So an S corporation is the third type of business entity that we'll discuss. Any type of corporation has to be formally organized with a state in order to be treated and to be viewed as a corporation. An LLC that elects to become treated as a corporation for income tax purposes is also grouped in with corporations. So to form an S corporation, you need to file articles of incorporation with the state. Once you get that entity approved by the state, then you're ready to start operating business. A big advantage of an S corporation over an LLC, especially for a services or an operating type of business, is that not all of your income is subject to self-employment tax. In an S corporation, you have two roles as the owner. You can be an employee, where you take a wage, you get a W-2 at the end of the year reporting your wages, and then also you're an owner or an investor in the corporation. So you're entitled to some level of return on your investment that you get back in the form of a distribution at the end of the year, or as often as the shareholders decide to make a distribution. One of the advantages of an S corporation, just like an LLC, is it's not double taxed. So all of the income that's generated by the business is reported to you on a K-1, and then you report the information from the K-1 on your personal return, and if there's any taxable income, then you pay tax on that business's earnings with your personal tax return. So the business itself doesn't have a corporate level tax. That's a big advantage here. Also, you're able to have some level of return on your investment, whereas in an LLC, if you're active in the LLC, all of your earnings are generally going to be subject to self-employment tax. With the S corporation, you don't have self-employment tax, but you do need to make sure you're taking a reasonable wage. And this is the number one item that IRS looks at when they're auditing S corporations, is reasonableness of owner's compensation. The ownership structure of an S corporation is somewhat more restricted than an LLC. You don't have as much flexibility. There are limitations on the number of owners, currently at 100 owners. And also, the owners have to be U.S. citizens or residents of the U.S. So that's a further restriction on the ownership. An S corporation does have to be a domestic corporation, and it can be owned by certain types of trusts or estates. There is some flexibility there. There are a lot more restrictions on the ownership than what you have with an LLC. An S corporation files Form 1120S, and of course, as I explained earlier, you would get a K-1 from the S corporation showing your share of the earnings. So that way you're able to avoid double taxation. Usually where an S corporation makes sense is an operating business. If you have a farm or a manufacturing facility or another type of operating business, if you're a services business, then an S corporation might be the best way to go as a choice of entity. If you have real estate involved in the business, then you can have the real estate held in an LLC, and you can rent that real estate from your LLC, and your S corporation would just then pay rent to the LLC. So a lot of flexibility when you start to combine entities and get the best benefits for the type of business, looking at the real estate as a separate business from the actual operating or service providing business. The fourth and the final type of business entity that we're going to talk about today is a C corporation, or a traditional corporation. A C corporation has to be formally formed with the state. One of the benefits of this type of corporation is that there aren't any restrictions on the shareholders. So you can have foreign shareholders, you can have domestic, you can have unlimited number of shareholders. It can be owned by any other type of business entity. And generally, where an advantage for a C corporation comes into play is if the company is going to be a very large company that has plans on going public. Otherwise, the advantages of a C corporation are generally outweighed by the advantages of an S corporation and avoiding that double taxation. With a C corporation, the corporation itself does pay the income tax on its earnings. And any excess earnings that the shareholders or the owners decide to take as a dividend is then taxed to the individual shareholders as a dividend. So you get that dual layer of taxation, which generally is a very big disadvantage. Most small businesses are not formed as a C corporation, or if they are, they make an election to be taxed as an S corporation to avoid that double layer of taxation. One final advantage of a C corporation is that the corporation can have a fiscal year end instead of just being stuck with a calendar year end, which generally the other types of business entities have to be a calendar year end. There are some exceptions, but with a C corporation, you can have any calendar month end as your year end. So you can have a fiscal year end that coincides with the seasonality of the business that you're operating, such as agriculture or anything else that may be highly seasonal. Even if you're in retail, there might be some seasonality that you would get some advantage of closing the books and wrapping up the year-end accounting outside of your busy time of year. So that fiscal year-end can potentially be a very nice advantage with a C corporation. In closing, I just want to show you this chart that shows some of the advantages and disadvantages of the different types of business entities. As you can see, there are clearly trade-offs between each of the different types of businesses. So you have to look at your particular business and decide what entity is right for you. Knowing all of these facts and the pros and cons of the different types of entities. And in most cases, an operating business is best off as an LLC or an S corporation, whereas a business that is rental or real estate intensive is generally best off as an LLC, filing as a partnership. However, if you are a very small business and just have a couple thousand in revenue every year, you may not want to go through the cost or the complexity of forming a protected type of entity where there's some legal protection. So you may be best off filing as a sole proprietorship, especially if you have plans on just running the business for a short period of time and then winding it down, if it's not going to be a continuous, ongoing business activity. Thank you for watching this video presentation. If you have any more specific or more detailed questions, we'd be happy to set up a meeting to discuss those with you.